Today, many still view the war in the Persian Gulf as a regional crisis that only concerns oil, the Strait of Hormuz, and the countries of the Middle East. But in reality, the consequences could be much broader. This conflict potentially hits not only energy, but also the very fragile foundation of the modern American economy. And most importantly, it could hit the sector that has in fact supported all the growth of the United States stock market in recent years. We are talking, of course, about artificial intelligence. Right now, the American market lives in a reality where artificial intelligence has become the main magnet for capital. Huge amounts of money are being poured into neural network development, data centers, chips, cloud infrastructure, and everything related to computing power. In fact, it is this very topic that has become the main driver of optimism on Wall Street. The growth of the largest companies tied to artificial intelligence was pulling up the entire S&P 500 index. And the problem is that such a system only looks powerful on the surface. In reality, it rests on several extremely vulnerable pillars. If at least two of them start to crumble at the same time, the consequences could be much more serious than a typical market correction. The first pillar is money. And not just any money, but external money that has flowed into the American financial system for decades from the oil monarchies of the Persian Gulf. The mechanism was simple and clear. Countries in the region sold oil for dollars and then returned a significant portion of those dollars back into the American economy. They bought stocks, bonds, real estate, invested in funds, venture projects, and technology companies. In other words, while America consumed oil, the Arab states financed American assets. And here a very important point arises. When people talk about the wealth of the Persian Gulf countries today, they often forget that this wealth isn't just sitting there as dead weight. It's deeply embedded in the global financial system, especially the American one. In many ways, it is this capital that has become one of the hidden supports of the current technological boom. This means that if these countries start having serious economic problems, it stops being just their local trouble. It becomes a risk for the United States markets. If the conflict around Iran and the Strait of Hormuz drags on, the Gulf states will start not just losing income, but burning through reserves at an accelerated rate. Exports decline, logistics, aviation, tourism, and trade suffer, and financial flows are disrupted. And even if they have huge margins of safety, they are not infinite. At some point, any major crisis presents the elites with a simple choice: either maintain external investments or pull the money out and save their own economy. And if this moment comes, the most dangerous part will begin, because a massive sell-off of American assets by major Middle Eastern investors could deal a powerful blow to the overheated tech sector. And that is exactly what is currently the face of all market growth. When the market is propped up by just a few giants, the system looks strong, but in reality it becomes even more vulnerable. It only takes knocking out key buyers for the euphoria to start turning into panic. Especially if investors suddenly realize that behind the pretty story of artificial intelligence lies not infinite growth, but a dependence on external capital, geopolitics, and very narrow supply chains. And this is where we come to the second pillar. It is no longer about money, but hardware, or more precisely, semiconductors. Because all of artificial intelligence, all these models, servers, data centers, loud presentations, and promises of a technological revolution do not exist in a vacuum. They need real physical chips. Without them, artificial intelligence is just an idea on paper. The problem is that the production of the world's most advanced chips is concentrated in literally a few locations, and the main one is Taiwan. Many people perceive NVIDIA as the main symbol of artificial intelligence. And indeed, it is their chips that form the basis of almost all modern artificial intelligence infrastructure. But there is a detail often overlooked. NVIDIA does not manufacture its own chips, it designs them while they are physically created at the facilities of a Taiwanese giant, without whom the entire global tech industry is unimaginable today. That is where a critically important part of the computing power is born, which supports the largest artificial intelligence platforms. And this is perhaps the main vulnerability of the entire modern economy. Trillion-dollar corporations, billions in investments, all the euphoria surrounding AI, all of this depends to a huge extent on a single manufacturer located in one geographical spot next to China, which has never given up on the idea of establishing control over Taiwan. It creates a striking picture. The market is betting on the technologies of the future, but that future is literally hanging by a very thin thread. Now let's connect all of this into one chain. On one hand, the war in the Persian Gulf threatens energy routes and the financial stability of wealthy Arab nations that have invested huge sums into American assets. On the other hand, this same instability hits global industry because East Asia, including Taiwan and South Korea, is critically dependent on stable energy supplies and uninterrupted global logistics. And if you add to that the growing military pressure from China around Taiwan, we're not just looking at two separate crises, but a single system of risk. If tensions around Taiwan escalate into something more, advanced chip production could stop, not because of anyone's political will, but because the infrastructure itself will simply become inoperable. Modern factories depend on equipment supplies, software, materials, international logistics, and stable energy. A break in even part of this chain already puts production at risk, and if the chain breaks completely, the entire artificial intelligence sector finds itself in a position where there's nothing left to grow on. And that's when we'll see the most dangerous thing, not just a drop in individual stocks, not just a tech sector correction, but the destruction of the main market narrative of recent years. Because today, investors believe in artificial intelligence not just as a technology, but as a justification for any valuation, any capitalization, and any expense. If it suddenly turns out that the physical basis for this growth no longer exists, the market will start recalculating everything from scratch. And this could bring down not only chip makers and model developers, but the entire broad market. The most dangerous market self-deception today is that many still think in terms of the old world. They think that if one factory fails, another will quickly replace it. If one supplier fails, a backup will appear. If one country becomes too risky, production will move to another. You can't just pick up and move a complex technological process like furniture from one apartment to another. It takes years of setup, colossal costs, thousands of engineers, a unique ecosystem, and high-precision equipment. That's why all the talk about the market supposedly having already priced in the risks around Taiwan looks far too naive. No, the market hasn't priced them in. It's just used to pretending they're far away, somewhere over the horizon, in the category of events that might happen sometime later. But the problem is that the worst crises always look like that, something abstract until, in an instant, they become reality. Then it turns out that no one has prepared any real scenarios for rapid adaptation. In this sense, the Taiwan story is dangerous not just on its own, but also as a psychological trap, because for years the market has lived in an atmosphere of almost religious faith in technological progress. Any new model, any crisis, any productivity gain is instantly presented as proof that an almost infinite growth cycle lies ahead. Investors are starting to pay for companies as if all restrictions have already been lifted, as if computing power will keep growing non-stop, as if infrastructure will only expand and demand will only accelerate. But this whole picture falls apart the moment it becomes clear that in the physical world there are limits that no amount of marketing can simply override. Because artificial intelligence is not magic, it is something very tangible. It is electricity, cooling, rare earth elements, logistics, undersea cables, factories, lithography, machines, containers, oil, gas, shipping, and the stability of international trade. If even a part of this material foundation starts to crack, then all that digital splendor suddenly loses its invulnerability. It is very convenient to talk about the future while sitting in the Chat-GPT interface, where answers appear in seconds and the stocks of related companies are hitting new highs. The reality here is that the true scarcity of the future will not be in pretty promises, presentations, or the number of neural network applications. The real shortage will be in things that are hard to replicate quickly. Energy, raw materials, physical infrastructure, factories, land, logistics, stable cash flows, everything that cannot just be generated by a new round of hype. If the digital superstructure hits a physical ceiling, capital will eventually start returning to exactly where there is a tangible foundation. So the main takeaway from this whole story might not even be that a catastrophe is bound to happen tomorrow. No, the market could very well ignore these risks for a while longer, continuing to grow and pretending that everything is under control. The main point is different. We live in an era where the trendiest and most expensive part of the global economy is built on a remarkably narrow and unstable base. And the longer this contradiction is ignored, the harsher the moment of awakening could be. The question is no longer whether Taiwan is important. The question is how much the world has overestimated its own security against a scenario where this hub stops working as it used to. The question is not whether artificial intelligence is overrated as a technology. It most likely will indeed change the world. The question is whether the path the market is currently taking to monetize this future is overrated. Because it is one thing to believe in a revolution, and quite another to think that the revolution will happen without glitches, shortages, shocks, or a geopolitical price. It is in moments like these that it becomes clear who built their strategy on reality and who on a dream, who understood the system's fragility and who just admired the rising stock prices, who kept a safety margin and who bet everything on a single scenario. The history of financial markets shows one simple thing over and over again. The biggest losses don't happen when the risk is unknown, but when it's known to everyone, yet they stop truly believing in it.